This screencast is looking at Summer 17 question 2, focused particularly on consolidation and the disposal of a subsidiary. So this question, Orman, covers one of the three main complications: disposal of a sub, the other two of course being a foreign subsidiary and a consolidated cash flow. So we're given three companies here: Orman, the parent, Pero, and then Quern. So we have to figure out then what type of investments they are. And we're given the statement of financial position for the 31st December 2016, and you can clearly see there the two investments are split out: 2.8 million in Pero, 1.4 million in Quern. Sometimes in other exam questions they'll put those together and you'll have to figure out what is what. So nothing else unusual stands out in the statement of financial position. Sometimes they might say intergroup trade payables, trade receivables, but it's not mentioned here. And in the P&L, nothing else really stands out so far, other than we have the three statements. So then the first thing you're always doing is just have a quick look at the financial statements and go through all of the notes and mark it up as you go along. So for example, Orman is the parent. They acquired 160,000 25 cent ordinary shares. So write down what percentage is that. Well, there is 320,000 ordinary share capital in Pero, euros. And if each share is worth 25 cents, you divide by 0.25, there are 1.28 million shares in Pero, and you bought 960. So put down there, that is 75%. So make sure you watch out for that 25. So you bought 75%, and that was nearly 10 years ago, or 7 or 8 years ago. So it's a prior year acquisition. So you owe 75%, the NCI is 25%. Retained earnings were at that date, 1290, and you can see up here, they are now 7085. So you had post-acquisition profits that we have to deal with. There was a fair value adjustment of 80,000, and you'll notice here it is land. What that means is there's no fair value depreciation, because of course land is not depreciated. And NCI is held at its fair value, which was 550. So we're using method 2 here to value the NCI. So nothing too complicated there in terms of doing your goodwill calculation. Then at the year end this year, so no, not prior year, this year, goodwill was impaired by 420,000. So we have to deal with that. And a good student will draw a link between NCI at fair value and the goodwill impairment. That will impact how we allocate it out. So 4 years ago, start of 2013, they entered a joint arrangement to carry a specific project with a third-party company, and they set up a new company. And both joint parties are equal to the net assets. So of equal rights, 50-50 to the net assets. So that means this is a joint venture. So the first thing you should be writing there is IFRS 11. This joint arrangement is a joint venture because it's a separate legal entity and it's right to the net assets. So you write there IAS 28. You're going to account for it under the equity method. And during this year end, there was a dividend paid by the joint venture, and we're going to have to count they posted the dividend received in other income. So if you come up here, that's 75 other income. That is the 50% share of the dividend from Quern. And we know that's not how you account for the equity method dividends. So 3 and 4 will be done together. Put a flag beside that. That is a joint venture. And here's where the main complication comes in. At the year end, that's important, that's the date of disposal, you disposed of the entire investment. So you got rid of your whole 75%. So this scenario is going from a subsidiary to nothing. And you got 8.2 million in. So what we're going to have to do is we're going to have to do a profit or loss on disposal calculation at the end of the year. But to do that, you need everything else at the end of the year as well. So we'll come back to that. But your number 6 then is the parent bought goods off the sub. So sub is selling to parent and the joint venture is selling to the parent. So for certain amounts. And all of these goods were used during the year. That means there's no unrealized profit. Because if all the goods were used and were pushed on, that means there's none still in inventory. And Orman, the parent, owes money to the joint venture at the end of the year. So we have to figure out what adjustments, if any, do we have to deal with parent and sub and parent and joint venture. Right. So the main requirements then, we're looking at 2 statements, but we're going to do a third as well. So we're going to do consolidated P&L, consolidated statement of financial position, and we're doing the consolidated statement of change in equity, just for tutorial purposes, to make sure we have it all set up. So similar to the previous question, the first thing is read the requirements, mark up your question. So we now have one parent, 75%, owning a sub, which is sold during the year, at the end of the year. And we have ownership of a joint venture as well, 50-50, because it tells you equal rights. So then we come and we set up the solution. Now I'm a big fan of setting up a template up front, 1 page for the P&L, 2 pages for the statement of financial position, and 1 page for the statement of change in equity. We're just doing it for completeness. And after that, then you do your workings. And I would leave 2 pages or 3 pages for goodwill, NCI. Now we have an additional one here because you're going to have a working for disposal. So you wouldn't have had that in a vanilla question, and a working for your group retained earnings. So maybe leave the first 2 pages for those big workings, and then we'll come down and start doing our little journals thereafter. But the biggest thing with a consolidation is reading the question, marking it up, and setting up your answer booklet at the start. Because if you do that well, everything else flows from that. So we have a 75% sub, prior year acquisition, and sold this year. So that's going to be important at the 31st December. Just tidy up that. And then we also have a 50% joint venture. So we know it's 50% because I said it's equal rights. So the first thing we start then is we work through some of the journals, any journal we need to make before we can do goodwill. And we have one journal we need to make here, the fair value adjustment. So we were told in the question, the fair value of land is 80,000 bigger than it's currently in the book. This would have happened back in 2009, but we don't depreciate land, so you don't have any fair value depreciation thereafter. So what we'll do then is just debit PPE, credit goodwill calculation. Now you don't have to give the journal entries, but I always show them just to make sure students are happy where the debits or credits are coming from. All right. So again, I'm dropping the last 3 zeros just to make it more straightforward. And again, just right there, no fair value depreciation as it is land. And land is not depreciated. So usually you'd have depreciation, but this time it's land. So if we go down through the rest of the note, nothing else there impacts the goodwill calculation until we get to the impairment. So once you have enough of the journals done for goodwill, you then do calculate your goodwill. And we're going to look at the parent 75% share and the NCI 25%. So the investment and the fair value, because we know the NCI is measured using method 2. So the investment in the 75% is given up here. They invested 2890 for their 75% share, and you're told the fair value of the NCI down here is 550. And so you can put the totals there. Just put that total. So that is the NCI, and that is the parent. And then what we need to figure out is what was the fair value net assets at the date of acquisition. So we go fair value of net assets at acquisition. You have ordinary share capital. If you go back, figure out what else we have. We have share premium, there's none for the subsidiary, and we have retained earnings. So retained earnings. And you have your fair value adjustment, and I cross-referenced there journal 1. So you see the way I distinguish the bigger workings, your goodwill, your group retained earnings, they always are reference working 1, working 2, and the smaller little adjustments I call journals. So you don't have to give the debits or credits, but it's good practice so you know exactly where it's going. So ordinary share capital here was 320. Just be careful now, retained earnings are not the 7085. That was 7 years later at the end of this year. At the date of acquisition, they were 1290. That was given to you in the question. And a fair value adjustment of 80. So a fair value of net assets or 1690. So your goodwill at acquisition is 1750. Goodwill at acquisition, i.e. the 1st 2009. So that's your first port of call, and there's always marks going for that, calculate goodwill. And just for illustration purposes, if you split that 25% and 75%, you will see that there's some goodwill attached to the parent share, and there's some goodwill attached to the NCI. So that is why it's important to know if method 2 is used, the next journal that we're going to do the goodwill impairment, you have to allocate it between the two, the parent and the NCI. The first step is always calculate your goodwill on acquisition. So we'll then come to journal 2, our goodwill impairment, and that is under IFRS 3. So we're told in the question here that there was a goodwill impairment this year, so that means it's all current year. There's no prior year split of 420. So the debit and credit here will be credit goodwill, the 420, and you're going to, the way I would do it is you debit group retained earnings and you debit the NCI. So I split it directly here. Some people might just say debit the subsidiaries group retained earnings. That's fine because you have to split it. The reason we split, because NCI is measured at fair value. That's the rule if you have to split it. So that's 25% and that is 75%. So some students, what they'll do is they'll take those now and they'll slot them into working 2 and working 4. Or what I'm going to do is I'm going to wait till the end and we'll do them all at the same time. So that's entirely personal preference. So our goodwill impairment for journal 2 is minus 420. So your goodwill at the year end, which we're going to put in the financial statements, or we're going to, in this case, we're going to use for the disposal, is 1330. So I should say our goodwill at disposal date, because at the year end, the company is selling the subsidiary. So that's an important figure, that 1330. We're going to use it in a minute to calculate the profit or loss on disposal. So even if it is a disposal, you have a lot of the same adjustments that you would have in any consolidation question. So the next thing we're going on, we'll take them in order. Journal 3 is the joint venture. So we said it's a joint venture because it has a separate legal company and they have the equal rights to net assets. We don't really have to check for gain from bargain purchase here because you set it up for the first time. So you're not buying a company, you're only setting it up, so there would never be a gain from bargain purchase. But you always have to think about gain from bargain purchase initially. And they put in an investment here of 1450. And if you can see here, 1450 is half of the 29. So just to prove it, if you want to see, check for gain from bargain purchase. Cost was 1450. Net assets at acquisition was just ordinary share capital, and it was 29 times 50%, which is 1450. So always when you set up the company, whether it's an associate or a joint venture, you're never going to have a gain from bargain purchase. So there's no adjustment there. Your starting point is going to be 1450 investment in joint venture. We then have to deal, we'll deal at the same note. We're going looking now at the dividend. Dividend was paid by Quern during the year and they posted dividend received to the other income. So they debited bank, credited other income. We know that's wrong. So you should be here debiting group retained earnings and you're going to credit investment in JV. All right. And that is going to be, just give an extra space. Just be careful, 75, which is 150 times 50%. So although the joint venture paid 150, you only get half. And that's where it is there. 75 has to be taken out. They've accounted for it incorrectly. So what I've forgotten up here, we'll do it as well. Don't forget to label that with your 3 stars and the S. That signifies that 420 is going to be an expense this year, and it's going to be allocated towards the NCI as well. That's the approach I'll take for that. Whereas here, this 75 is going to be 3 stars only, because that doesn't impact the NCI. That's going to impact here, if you want to put it down, other income. That's where that adjustment is going to be. So that's the second part of your investment in JV. And finally, then we're looking at the post-acquisition profit for the JV. There's a bit of a trick here, so you need to watch it. Retained earnings at the year end for the joint venture, we're told, are 2100. That's the statement of financial position. Retained earnings at acquisition, we know were nil. Because, of course, you set this up in 2013 when you wouldn't have any retained earnings. But importantly, you add back the dividend paid this year. So the dividend was 150. So the true retained earnings will have been post-acquisition 2250. Now that's slightly different than how we deal with the subsidiary. In the subsidiary, we net off the dividend, leave it net off, because that's the way it's accounted for. Remember, this is the equity method. So we want to show the gross share of profits. That's why we add the dividend back. And we net the dividend off in the investment. So that's why we're adding back the total dividend here. So the share of post-acquisition profit then is 50%. So that's essentially 1,050 from here, and you add back the share of dividend as well. Because that 75 has to be shown up in the profits. So it's kind of like showing a gross and taking the dividend off elsewhere. So that's an important one, particularly that adjustment. So watch out for that. It's slightly different. We have to show all profits earned before the dividend is paid. So it's slightly different than the subsidiary. So that'll be debit investment in JV, 1125, and credit group retained earnings, 1125. Now again, what I want to point out to you here is there's an important split. Current year, what's going into the P&L, because this is since 2013. So 13, 14, 15, and 16, 4 years. The current year amount that's going to go in is 1410 at 50%. So you're looking at 1410 times 0.5 is 705. The difference, prior year statement of changes in equity, 1125 minus 705 is 420. So that's important that the current year share of profits taken from the P&L, that'll go to the P&L of the group this year. The rest of it, the difference between the cumulative and the current, is your prior year, and we will see that will be an opening balance of group retained earnings. So just bear that in mind when we come back to it at the end. But use your labeling system to help you along. All right. So that's dealt with the joint venture, and we'll show you the working 5 then for the investment in joint venture at the end of how you might finish it off. All right. So then we'll go down and we'll have a look. So we're now dealing with the disposal. All right. So there's a bit of work here in the disposal. So let's work our way through it. So you're told disposal, the entire investment in Pero for consideration of A2 and received at that date. So 31st of December. So when you're doing a disposal, you need to get all the key items at the date of disposal. So what we need, we're going to do working 3 here, and I'll show you the corresponding journals as well. We're going to calculate the profit or loss in disposal. So the cash received was 8 million. So you're told that in the question, or 8.2 million, should I say. So on that date, what did you get rid of? You had net assets, you had goodwill, and you had NCI. So at disposal, goodwill at disposal, and that is of course coming from working 1, and you had net assets at disposal. So that's the key thing. They make it a bit easier here because you have a lot of the things at the year end already. So for example, the net assets here at disposal, they are going to be the net assets at the 31st of December, which are 7405, coming from 7405, but be careful, plus 80. And that 80, of course, is for the fair value adjustment. So you brought in an extra 80. So what that means is you have to take out that 80 as well when you're dealing with the disposal. So watch for that. That comes back in here. The goodwill at disposal, we've already calculated, 1330. Right, so you've done that calculation there as well. So that means the last thing you have to do, and you always have to do this before you do the profit or loss of disposal, is, well, what's the NCI at the year end? So that means we're jumping to working 2, is what is the NCI at disposal? Because we need that to feed in here. So there is a bit of a chicken and egg sometimes, and that's where students struggle with the disposal questions. There's a lot of moving parts in it. So the value of NCI at acquisition from working 1 was valued fair value 550. We have a look over here. Did we have any adjustments to NCI? So journal 2 minus 105 for the goodwill impairment, the first one, and no other adjustment there. So the only other thing we know that the NCI is entitled to is post-acquisition profit in the sub. So retained earnings at the year end in the sub was 7085. Retained earnings and acquisition we know were 1290. So post-acquisition profit in the sub, since we bought it about 7 years ago, 5795, and the NCI gets 25%. Much the same as you do any NCI, except doing at the end of the question now, you have to do it before the disposal happens. So that is a net adjustment there of 1344, and that will get you NCI of 1894. So I'll put there NCI at disposal. You have to do that beforehand. So that's why it's useful. Leave your workings. So the way I kind of put a box around these, leave those pages blank so you're ready for doing them, because you're always going to have those, and that's where your marks are going for. Goodwill, NCI, group retained earnings, and a disposal if you have it. So I just cross-reference there, working 2. And that is a minus because that is an equity balance. These are debit balances. This is a credit balance. So the net assets that you're taking away, 6921. So what essentially you're doing in the group accounts, you're taking out all of these, the net assets plus the fair value adjustment. You're taking out goodwill and you're taking out the NCI. And what you're bringing in is cash. And the cash here is bigger than what you're taking out. So that is a profit on disposal. So it's not a bad question at all if you practice it. And that's your profit and disposal calculation complete. Now I'll show you the relevant debits and credits as well, but that's what you have to do. Is it's only a simple single entry. You figure out what you're taking out at the end, and to make it more complicated, an examiner might say the date of disposal is the 1st of July. Then you'll have to work towards the 1st of July for everything. So just bear in mind what the date is. So let's do then journal 4 just to show you the debits and credits. Again, this wouldn't be necessary in the exam, just for completeness. Debit bank, A2. You're going to credit net assets, 7485. Now, technically what you will see, what we're going to be doing is when we come up to our statement of financial position, we're going to be crediting the 6450. Get rid of that, credit the inventory, credit the trade receivable. And the benefit we have of that is we know these are the date of disposal. It won't always be the case that you will get the statement of financial position at the date of disposal. So I said usually we just put a summary there, credit net assets, but individually what you're doing is you're crediting the assets and debiting the liabilities. You debit NCI, get rid of that, 1894, and you credit goodwill. Get rid of that, which is 1330. So the balance there is to credit group retained earnings, 1279. And that will have 3 stars beside it because that is a current year disposal. So that means it's going to go into the P&L this year. Right, that's an important one to make sure you're happy with it. Because I said a disposal, complicated question, it's just going to have one extra adjustment. And that means, remember now, at the year end, we will have none of the subsidiary left in the statement of financial position. It will be there for the full 12 months. So none of sub left in SOFP at year end, but in the Consol's blocky for full 12 months because it was only disposed of at the end of the year. So it'll always be in the blocky for how many months it was kept in there. So that's an important point as well. So then we come to journal 5, the last one. And this is here. We have trading between the parent is buying off the sub. So the sub is selling to the parent and the JV is selling to the parent. So 2 different elements. So firstly, the sub Pero is selling to the parent, 380,000. So first thing we know is we're going to debit revenue and credit cost of sales those amounts, 380, 380. Because you cannot sell to yourself, so those are adjustments that are going to have to go in. And what we call the top line adjustments. Reduce your revenue, reduce your cost of sales. In addition to that, we're saying, well, that means all these goods were used, so that means there's actually no unrealized profit. And one thing to watch here, if there was unrealized profit, you would have had to do note 6 before note 5. Because if there was unrealized profit here, that would have been in the subs accounts. And that would have meant the NCI would have got hit, which would have meant the NCI at disposal would have got an extra adjustment. So just be careful of how sneaky the examiner could have been if there was unrealized profit there. We knew from reading the question at the very start there wasn't, so we didn't have to worry too much about that link. But in other questions it may not happen like that. The other thing then is the trading between the joint venture and the parent. Now here, because of the equity method, you do not remove revenue and cost of sales between parent and associate, and you do not remove trade receivables and trade payables between parent and, JV. Should be said there. So the key point here, when it's the equity method, and this is what the examiner was testing your knowledge, why they put both of them together. You never remove the revenue and cost of sales, because in the equity method, they were never added together in the first place. Same logic with trade and other payables and trade receivables. Only on full consolidation, i.e. with the subsidiary, would you ever make those adjustments. So that is why when you look at the solution, nothing is done for that piece. But to get your marks there, you'd have to write down those lines, IAS 28, equity method. Just to show the examiner, that's why you're not making adjustment. It's not that you forgot about it, it's that you know when it's between a parent and a JV or a parent and associate, you don't eliminate those because they were never added together. In the first place, it was only the equity method that was used. So they are all your main little journals. And the only last working we have then, we have 2, group retained earnings, and then we'll do working 5, investment in JV for completeness as well. Just up where the big marks are going. Group retained earnings, you always start off with the parent at the year end. And the parent's retained earnings at the year end were given up here. 45325. Then we go through and think of what adjustments do we make to group retained earnings. Nothing in journal 1 because we said land is not depreciated. We debited retained earnings 315 in journal 2. So journal 2 minus 315. Journal 3 in the investment in the JV, we debited 75 for the incorrectly treated dividend, and we credited 1125. So journal 3, minus 75 plus 1125. So you're just tracking them as you go. And as I mentioned before, a good student here, they might slot them in as they go. Rather than waiting till the end, we have to go back over each adjustment as well. So it might make sense to try and slot them in if you have the workings opened. Journal 4 then, we made a profit on disposal of the sub, 1279. And journal 5, that has no impact on group retained earnings. They're just P&L adjustments. So the only other thing we have to do then is the post-acquisition profit on the sub. Now you don't have to reinvent the wheel. This will always be done in the NCI as well. We said the post-acquisition profit was 5795. 5795, and you might just see it say there, C working 2. So you don't have to do it twice, it's the same figure. The NCI was going to get 25%, and that means group retained earnings gets 75%. So they're we'll just do rounded to 4346. So they're very symmetrical adjustment to why they're always done together, because you'll always have that post-acquisition profit of the sub at the end. Right. So there's some of your adjustments so far. And the one important thing to note then is keep it nice and neat. See the way the examiner can clearly see where the journals are. That's why I like to call it J1, J2, as opposed to the bigger workings, because you'll always have these. That's where the bulk of the marks are going for. So we'll tot up those adjustments, and that will get us closing retained earnings 51685. So I'll call that group retained earnings at the year end. And that can be slotted into the statement of financial position. But it's nice and neat, and there's no messing, and it's clearly cross-referenced. The examiner can see where the workings are coming from. So the final one then, to finish off here, investment in JV, the initial cost, 1450, and then in journal 3, we had 2 adjustments. So I said this might be a bit overkill to do it, but it's just no harm for completeness. We credited investment 75, and then we debited the investment 1125. So journal 3 minus 75 plus 1125. So again, whatever way you want to do it, the only other one you might have there would be gain from bargain purchase if it was in it. So the investment in the JV at the year end is 2.5. Investment in JV at year end. And my 5 little workings are net kept separate. That's where the bulk of your marks are going. If you can do working 1 to 5 there, you're going to get an awful lot of the marks. They're the big bulk ones, and that's why I say leave pages separate and do them well. Alright, so that's an important part overall of that question, is the layout, the distinction between the smaller little journals, smaller little adjustments if you want to call them that, and the bigger workings. So once you have all those done, you have the back broke on this question. We're now going to go up to the P&L, and we're going to finish off the financial statements. Now, I have this set up already, and you might want as well. Just leave a space usually under finance costs, because you want to figure out whether it's a share of profit in JV or whether it's a share of profit in associate. In our case, in this question, it was a JV. And the other little box I always put here is, should it be 6 out of 12, 3 out of 12, or 12 out of 12? And in this case, you sold the sub at the very end of the year, so it was there for the full year. So while you don't have any of the subsidiary left here in the statement of financial position, it'll all be in here. And if you sold it halfway during the year, it'll be 6 over 12. So make sure you practice those in terms of how you adjust pro rata. So let's just slot in all our 3-star labels. Again, you may have slotted them in as you go along. I'll just leave it in the end. So any label we think, goodwill, an extra 420 in admin expenses. The full adjustment goes in here, and we allocate it down the bottom. That's what the capital S means. We have removed the 75 from other income. We said that's incorrectly accounted for. So that's where the label very useful. For share of profit in JV, it's only the current year, 705, not the full 1125. That difference we'll see in the statement of change in equity. So that's 705. And then keep going down along. We have 1279, profit on disposal. We just put it in admin expenses. Again, if you wanted to put that in as a separate line item, that's fine. Probably should go as a separate line item because it is a material transaction. So it usually has to be disclosed separately in IAS 1. And finally then, we've no unrealized profit. So we just remove the revenue and the cost of sales. So minus 380 to reduce the revenue, plus 380 to reduce the expense. So there's a nice little method there, nice little sequence of steps. Use your labels, use your template that's set up already, and leave space. You're not going to get docked for leaving space. So we work our way across then the P&L. I'll just tot them up for you. You get your parent plus sum plus adjustments. Same here. And you get your gross profit. This is now nil because the 75 is wiped out. Distribution costs, 3250. Admin expenses, minus 1891. And again, if you wanted to leave that 1279 separate, that's fine as well. And finance costs are 380. So that gives you profit before tax for the group of 2294, 90 of tax expense, which leaves you a group profit after tax of 2204. And the next important point then is, well, that in that 224 is all the subsidiaries' profits, but we know actually the NCI is entitled to 25%, so it's going to be the 200, but be careful, the capital S down here also means 420 must come off it, minus 420 times 25%. So that means they're going to be a negative 55. So that's an important one to watch for. Whatever expenses have to be allocated are allocated down the very bottom. You always put the full amount in here. And what we're saying is, yes, the NCI is entitled to 25% of that, which is 50. But they also have to get allocated, as we've done directly here, 25% of the 420, which is a negative 55. So that's where the negative 105. So plus 50, quarter of that, minus 105 is your minus 55. And the balance then, it can be just shown as that. You don't need to prove it or anything. But that's important that you can allocate out exactly where the NCI profit is coming from. So the answer there is 2259 for the parent. So we then come to our statement of financial position. Just be careful because now the subsidiary has to be removed, but be careful because there's other adjustments that have to go in before that as well. So for example here, property, plant and equipment, plus 80, that's coming from journal 1. And what a good student might do here is, they might annotate each of these adjustments. I can't do it in Excel, but you should be able to do it in your script. J1, J2, etc. Just to show the examiner where it's coming from. And then you also minus 6450. The reason being here, that asset is now taken out at the end of the year because the subsidiary is being sold. So you minus the 6450. And be careful, you minus the 80 as well, because you're saying that fair value adjustment has to be taken out. So you bring it in as part of the goodwill working, you take it back out as part of the disposal. So all you're left with at the year end is the parent. That's the key point. Everything is wiped out. Investment is gone, and investment in Quarren is gone. What we're left with instead is goodwill, and we're left with investment in JV. So goodwill is working 1, investment JV is working 5. So to show these then, your goodwill was, if you look at the question, working 1, it was 1750 to start, plus 1750. Then you did minus 420 for the impairment, and then you minus 1330 as part of the disposal. So essentially your goodwill is nil at the end. If you just wanted to cut to that, that's fine as well. But sometimes the examiner likes to see your workings of where it comes from. And this is 2.5. Because the investment in JV is the only thing that's left. Everything to do with the subsidiary is removed. And that is 44,810. Inventory, the only adjustment, get rid of the subsidiary. Get rid of the subsidiary and get rid of the subsidiary. And bring in your proceeds. So remember we debited bank, so you have to do both. Get rid of the subsidiary's cash and bring in the proceeds. Now you don't have to show the sub here if you don't want to. You can just show the parent column and the net adjustments here. I'm just doing it for completeness the way we would normally do it. So you sum that across, you're just left with the parent. You're just left with the parent, and you're left with the parent plus the proceeds. So that will be 88. Because they sold the sub, they brought in the cash. So current assets, 17.3, and total assets then, 62.2. Nice and structured approach, but again, these are complicated questions, but this is the advanced level now in terms of consolidations. Share capital, remove the subsidiary. There's no share premium, that's fine. And retained earnings, we said was working 4, and NCI working 2. So your NCI at the year end, we said was 1894. So you bring it in and you take it back out for the disposal. Again, if you just put it in as nil, that's fine as well. So you can say working 2 there, but also working 3 because you're bringing it out in the disposal. Retained earnings at the year end from working 4, nice and neat, 51,685. And share premium 150, and the share capital is always the parent as well. So a lot of these workings will have been done already. So that's your total equity is just to do with the parent, 52,435, with no NCI at the end of the year. Long-term borrowings, you get rid of the subsidiary, minus 800. So that means you're going to have just the parent left, 53. Trade payables, you get rid of the subsidiary, and you get rid of the subsidiary. And the reason we're doing that is it's all disposed of at the year end. So that is just the parent, and just the parent. So I've gone it the longer way by putting the sub in and then taking it out, but it's probably the easiest way from a tutorial perspective not to be skipping too many steps early on, just till you get comfortable with how to approach it. So your current liabilities then are 4465, and total equity and liabilities, are just adding them up, thankfully 62.2 million, which is the same as your total assets above. So what I want you to think about now is how you approach the question. Because if you have an approach, a disposal question is probably 80% the same as a vanilla question. The hardest 20% then is at the end is doing your disposal calculation out. And this one was a relatively straightforward one that it was at the end of the year. You could get a disposal halfway during the year, or you could get a disposal where they don't sell all of their investment. They could be left with an associate, or they could be left with a simple investment. So you just need to look at each scenario to make sure you're comfortable with it. So what we're going to do to round it out then, just as for tutorial purposes, let's do our statement of changes in equity. So we're taking these balances at the end of the year. So we're going to have 4 columns and seeing can we reconcile back to the opening balances and even prove where they come from. So we'll just take that. Balance is 600. Share premium was 150. Retained earnings 51,685, and the NCI was nil because it was disposed of. So let's see then, well, can we reconcile back to the opening? So we know we always have profit for the year. That's coming from the P&L. So I always leave the statement of changes in equity to the end because that will allow you then to have the elements to put in. So retained earnings, the share of profit attributable to the parent, 2259. And minus 55 for the NCI. So that's your profit for the year, 2204. So that's how you'll allocate it out. So then we're saying, well, if we can reconcile back, opening balance must be ordinary share capital 600 and 150 for share premium, which is fine. We're saying then something plus 2259 gets me to 51,685. So if you work back, take it off, you're saying the opening group retained earnings is 49,426. And we're going to see, can we prove that in a second? All right. The one thing we have here now is you're going to have a disposal line item to say that's how the NCI was removed, 1894. So that's when we have a mid-year acquisition, you have an acquisition line item to bring in the NCI. There's vice versa when you have a disposal. So the opening balance then must be 1894 plus 55. So we think the opening balance on the NCI is 1949. So again, that will get full marks in the exam. You don't have to prove whether you think these two are right or not, but we will show you that linking in the prior year adjustments, we can show you how they do are correct and how they do reconcile. So we want to know group retained earnings at the 1st of the 1st 16. So you start with the parent at the 1st of the 1st 2016, and that is going to be the parent at the year end, 45,325 minus the profit they earned in 2016, which brings you back to the start, 515. So the parent would have been 44,180. Post-acquisition profit from the sub, because remember you own the sub for a couple of years, is retained earnings at the 1st of the 1st 16 compared to retained earnings at acquisition. So the retained earnings of the subsidiary at the 1st of January, we calculate the same as we do for the parent. What's their year end? Their year end, 31st December, 7085, minus the profit of 200 for the year. So that is 7085 minus 200. So at the start of the year, the sub would have been 6885, and when you acquired it, it was 1290. So at the start of the year, the post-acquisition profit would have been 5595, and you are entitled to 75% of that. So we'll say there 4196 would have been the post-acquisition profit at the start of the year. just to show what goes into this figure. And the other one, a lot of students would have forgot, you're going to have post-acquisition profit from the JV as well. Because remember, the JV was owned since 2013. So to calculate that, you do a similar approach. The retained earnings at the 1st of January 2016. Now this is a bit trickier. You take the year end, 2100. You take off the profit for the year, which in this case was 1410. But don't forget, you add back the dividend. Because if a dividend was paid during this year as it was, that means it's going to be an adjuster to the end of year retained earnings. So 2100 minus 1410 plus 150. Retained earnings at the start was ZIL, because why? You set it up at the start. So there was no retained earnings there. So post-acquisition profit for the JV is 840 and your share is 50%. Now, that was a long-winded way of going about something you already have done. That if you look back here, we said of the 1125, 705 goes to P&L. The other 420 goes to the statement of change in equity. So that would have been in the P&L in 2013, 2014 and 2015. So that means your opening group retained earnings would have been 420 bigger with it. And if we tot those three up, we can prove 49426. So where group retained earnings is correct. So just have an idea of where it comes from. If we know the key movements, we can prove what's going on. And the last one then to prove the NCI. Proof of opening NCI. NCI at acquisition from working one, we said was 550. Right, that's just coming from up the fair value. And what they're entitled to, post-acquisition profit of the sub at the 1st of the 1st, 16, see above. So I'm not going to duplicate it. The above here is 5595. So that post-acquisition profit working is the same here as it is there. And they're entitled to 25%. So we'll say 1399. Just call that 25%. So if these guys, the group retained earnings, get 75, the NCI must get 25. The NCI has nothing to do with the joint venture. So that's irrelevant. So that means you're going to be left with 1949, which matches above. So there is a logic to it, and you can prove it if you take the time. Unless you're asked from the day of the exam, do not go and start proving those, because you're not going to get any marks. But just for tutorial purposes, particularly when you have a prior year acquisition, you're trying to think, well, if it doesn't go to the P&L, where does it go? It goes somewhere. Particularly if you have prior year adjustments, you just don't happen to see it because we work back to this plug figure rather than proving it from first principles. Right? So that was a very good question. Summer 2017 question 2 focused on disposal of a subsidiary.